Hi, I'm Sam, and I want to tell you all about letters of credit. And along the journey, this might even help your clients. Did you know SMEs account for 99% of UK businesses, and 46% of them experience some form of cash flow problems? Most of the trade in the world is done internationally. In order to facilitate this, a business needs to have trade agreements with their partners and counterparts. Trust is incredibly important when agreeing payment terms. Putting this on a scale, at the riskier end, trade can be done on open account terms, where the risk of the seller bears the risk of not being paid. A letter of credit, or LC, is less risky, and in this video, we'll explain why. Here at Trade Finance Global, we help companies find debt funding in the market with various financing structures to meet the business's needs. We want to help you explain debt terms to your clients and help grow your clients or help recognize future cash flow challenges. A letter of credit is relevant where there is an exporter and an importer, and there needs to be prepayment or confirmation of payment in order for goods to be shipped. A letter of credit is an instrument from a bank which guarantees a buyer's payment to a seller if certain criteria are met. If the buyer can't pay up, due to the agreed contract through the letter of credit, the bank will cover the remaining price. Letters of credit are fundamental components of international trade. They're governed universally by a set of guidelines called the UCP 600, which are issued by the International Chamber of Commerce. So, what is a letter of credit? An LC is a promise written on a legal document that comes from a bank with a promise to pay the holder if the holder fulfills certain obligations. Obligations include payment when the goods are shipped if certain criteria are met. A letter of credit is usually used when the buyer and seller do not know each other very well, and this is why it is used so frequently in international trade. Letters of credit are incredibly specific, and a close attention to detail is required. If there is a misspelling in the contract, for example the name of the goods is incorrectly spelled, there may be a non-payment until a new corrected LC is issued and accepted. So, what are the advantages of LCs? For the buyer, they are certain to receive the goods as stipulated in the letter of credit, and they do not need to pay for the goods up front. For the seller, they're somewhat protected against non-payment from the buyer. There are lots of different types of LCs, and I'll cover most of them today. Often, people get confused between commercial letters of credit, which act as a primary mechanism for a transaction, and a standby letter of credit, the secondary payment mechanism, a fail-safe guarantee. Depending on the perspective of the buyer or the seller, there are also import letters of credit, set up by the importer or buyer of goods or services, and exporter letters of credit, which are set up by the exporter or the seller. So how does a letter of credit work? On behalf of a buyer, the issuing bank promises payment to a seller or beneficiary. An advising bank may act on behalf of the seller. The advising bank will receive payment, normally when they have been presented of specified documents representing the supply of goods. So, why are letters of credit used? They're safe. Letters of credit are usually legally binding, and so all parties need to agree to cancel them. They offer clarity. The goods defined in an LC are specific and well defined, so the details of a transaction are generally very transparent. They offer risk reduction. The exporter or payment to the seller is guaranteed payment, providing the terms of the LC are met. They allow for safe trading. Letters of credit are a focus of international trade and allow companies to trade safely in unfamiliar markets with unfamiliar suppliers. They're efficient. Letters of credit can be raised electronically using an online trade banking service. There are several different types of letters of credit. I'm going to cover a few of them. The irrevocable letter of credit allows cancellation or amends to the letter of credit by the buyer if the buyer's bank, seller, and/or seller's bank agree. A confirmed letter of credit is a second guarantee by the seller's bank. It adds additional security for the seller. It means that if the issuing bank from the buyer fails to make a payment, the seller's bank agrees to guarantee payment. A transferable letter of credit can be passed from one beneficiary to others. They're commonly used when intermediaries are involved in a transaction and others are supplying the seller in the transaction. A letter of credit at sight. These are payable as soon as the agreed documentation has been presented and verified. Deferred or usance letters of credit means that the payment to the seller is delayed until an agreed period of time has passed. A red clause letter of credit permits the seller to receive partial payment from the issuing bank prior to shipping the products or performing the services. So how is payment collected on letters of credit? To receive payment, the beneficiary must present documentation of completion of their part in the transaction to the issuing bank and must present documents such as invoices, bills of exchange, or government documents. Thanks for listening to this talk on letters of credit by Trade Finance Global. Be sure to check out our other training videos and don't hesitate to be in touch with Trade Finance Global should you have any questions.